$280 million. That's all it took to crash the world's largest and most stable bond market. The Japanese government bond market, the backbone of global finance for decades, just broke. And when Japanese Prime Minister Takaichi told investors to calm down, that's exactly when we should worry most. Japan has always been the canary in the coal mine of global finance, showing us problems before they appear anywhere else. What's happening now is unprecedented in modern financial history. What actually happened? Japan's 40-year government bond yields surged past 4% for the first time since these bonds were created in 2007, hitting a record high of 4.23%. This wasn't a gradual climb. Yields jumped from 3.6% to 4.2% in a single session. In technical terms, this was a 2-standard deviation move. Pure panic. Here's the shocking part. The trading volume that triggered this earthquake was only 280 million in a market worth 7.2 trillion. To put this in perspective, imagine your $1 million house. Someone offers you $50 for it, and the market accepts that as the new price. That's essentially what happened. Why this matters? The market is gone. When I say the Japanese bond market doesn't exist anymore, I mean it's been hollowed out. The Bank of Japan owns over 50% of all Japanese government debt. The rest is held by institutions, pension funds, and banks who bought when yields were around 0.5%. Now yields are at 4%. These institutions are sitting on massive losses. If they needed to sell tomorrow, they'd have to dump bonds at drastically lower prices than they paid. Exactly what happened with Silicon Valley Bank in 2023. Same dynamic, and we all know how that story ended. The political trigger. Prime Minister Takaichi announced snap elections for February 8th and used 3 words that terrified investors: major policy change. In practice, this means more public spending, more stimulus, more debt. She announced a $135 billion fiscal plan and proposed suspending the 8% food tax for 2 years. Lowering taxes sounds good for people, right? But here's the problem. If you cut taxes without cutting spending, you must issue more debt. Japan already has a debt-to-GDP ratio of 250%, the highest among developed economies. For decades, this wasn't a problem, because financing costs were near zero. But when yields start rising, the math changes fast. The broken rule. What's happening in Japan breaks a fundamental rule of finance that's worked for decades. The rule: when interest rates rise, foreign capital flows in attracted by higher returns, strengthening the currency. It's basic financial physics: rates up, currency up. But in Japan, the opposite is happening. Bond yields are rising, but the yen is collapsing. The yen is at 160 against the euro, the lowest in 18 months. The yen has lost about 50% of its value since 2021. When this rule breaks, it means one thing: loss of confidence. Investors aren't viewing high yields as an opportunity. They're seeing them as a warning sign. This type of dynamic normally happens in emerging market crises, not in highly developed economies like Japan. The no-win scenario. The Bank of Japan is trapped in a no-win scenario with only bad choices. Option 1: intervene to lower yields by buying more bonds or cutting rates. But this crashes the yen further. A weaker yen means imported inflation. Japan imports energy and raw materials in dollars. Prices rise domestically and citizens get poorer. Option 2: raise rates aggressively to defend the currency. But with 250% debt to GDP and 4% rates, the interest expense explodes. The debt becomes unsustainable. Option 3: do nothing. Markets continue punishing the lack of fiscal credibility, yields keep rising, and the problem worsens. There's no good solution, only choosing which part of the system to sacrifice. Global impact. Why this affects you. Japan isn't just any country in the global financial system. It's the hidden pillar holding everything up. For decades, Japanese investors executed the carry trade: borrow yen at near zero rates, convert to dollars, invest in higher-yielding assets like U.S. treasuries or stocks, and pocket the difference. This mechanism pumped liquidity into global markets for years, kept U.S. and European yields low, and supported stock markets. But now Japanese yields are rising. If you can earn 4% at home in yen on government bonds, why take currency risk investing abroad? Japanese investors are bringing money home, selling U.S. treasuries, European bonds, and stocks. The same day Japanese 40-year yields hit 4%, U.S. 30-year yields jumped to 4.9%, the highest in months. French 30-year yields surpassed 4.4%, highest since 2009. German yields near 3.5%, highest since 2011. This is happening despite the ECB cutting rates from 4% to 2% over the past year. One of Europe's largest debt buyers, Japan, is stopping purchases. The gold connection and broader lessons. There's also a China connection. Japan and China are regional competitors producing similar goods. A weaker yen makes Japanese products cheaper versus Chinese products, putting deflationary pressure on China. China, already struggling with real estate crisis and weak growth, might be forced to devalue the yuan to stay competitive. When Asian currencies fall, citizens look for safe havens, like gold. Gold is near 2,800 ounce. It's not rising because Americans fear Trump or the Fed. It's because Asians do not know where to put their money. Chinese real estate is toxic. Chinese stocks are weak. The yuan could be devalued. The yen is losing value daily. Gold is the only asset without central bank printing risk. Conclusion: the end of an era. We are witnessing the end of the free money era, the era when governments could borrow without consequences, and central banks could buy everything while keeping rates at zero forever. Japan is showing us this first, as it always has. The lesson for investors: expect structurally higher interest rates, persistent inflation above 2%, and the potential for governments to use inflation to erode debt rather than make unpopular cuts. This isn't about panic. It's about awareness. The knowledge is our only weapon as investors. When politicians tell us to calm down, that's usually when we should pay closer attention.